Good morning and welcome to the Velocity Composites PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to the management team from Velocity Composites PLC. Rob, good morning, sir.
Good morning, everybody. So today we have myself, Rob Smith, CFO, John Bridges, the CEO of the company, and Andy Beedon, non-executive chairman. So I'd like to start the presentation by just a quick summary of the numbers, and then we'll dig into them a little bit more. Revenue 10.4 million, which is slightly down on the preceding half one, but we achieved much better margins due to operational efficiencies and some price increasing flowing through from the tail end of last year, which helped us to achieve an positive EBITDA in the half, which is the first time we've achieved a positive EBITDA in the first half since the pandemic, and it's the second sequential EBITDA positive half. Cash, we remain positive. We've got 1.2 million in the bank, and on top of that, we have an invoice discounting facility of up to £3 million that we can utilise. So we've got a good headroom to see us through the next growth period. John, if I can hand over to you.
Thanks, Rob. I can't quite read that, but essentially, before going to the wider presentation, just a bit of an industry outlook. I know we get asked sort of questions about what we see from our customers and the sort of wider industry. So I think fundamentally the industry still recognises that we're at aircraft production rates that are below the sort of pre-pandemic levels. And really there's been, I think you've seen it sort of certainly in the public domain around sort of supply chain issues. It tends to get put into that sort of bucket, but essentially we've got customers and ultimately OEMs trying to ramp up key programs like A350. Again, some of these sort of wider unplanned activities like the sort of separation of the sort of Airbus and the Boeing from the Spirit business and the reallocation of those facilities and production areas into the sort of requisite OEMs. That's been sort of fairly, we feel it's been fairly disruptive from what we've seen and what our customers have sort of fed back. But again, we're expecting that to sort of clear and a lot more clarity, and then those key production areas under direct control of the OEM should help to the wider ramp up activities. The sort of wider non-composite supply chain, there's been some sort of wider comment on that, but from what we see within composites, we see our customers are ready to ramp up. They've been at previously high rates. The suppliers that we work with are very ready and have been at high rates as well. From a sort of composite perspective, we're sort of ready to see those rates pull through. And again, from even recent orders, the order book of these key platforms remains very healthy and long term as well. So ultimately, we are expecting those rates to begin to ramp and flow through down to us. And obviously, as we said, we're ready and have the capacity to pick those up. Tariffs has been sort of commented on, with sort of some investors and comment out there. But again, because of what we do and how we do it, we do need to be close to customers. So all our manufacturing is within country, and we deliver quite locally to customers and serve customers locally as well. So we've not seen any direct impact on tariffs. And as we've talked extensively before, all our material is flow through pricing. So any changes to that landed price of materials is part of a wider price negotiations that we can pass through as part of the overall contractual relationship within our part of the industry. And then in terms of wider new business, we are looking at progressing and picking up new contractual opportunities with both new and existing customers, and that has continued at pace. And as we've said previously, particularly in the US, a focus there on the defence sector as we look to rebalance across civil and defence through our portfolio. Looking forward a little bit, as I mentioned, we are hoping these ramp-ups, they were delayed from last year. Some of our customers did start to ramp. We've dealt with, supported customers through rebalancing their line of balance and their sort of inventory following that, and to get that in line with where they need to be. And we've continued to work hard and support customers through that and deal with the sort of demand fluctuations that creates. We want those ramp ups to kick in. We're sort of looking at continue to forecast a flat on those key programs for this year, just really out of prudency, having seen the ramp ups delayed last year. But again, would be welcome, and our customers would welcome those ramp ups to begin to buy and flow through into our part of the supply chain as soon as. Quite a lot of live bids, some different stages, some quite new, some progressing through to what we hope will be completion, both in the US and Europe, and we'll talk about that later. And really capitalising on our footprint now being in Europe and US, and picking up some of those defence opportunities that we see with some of the large suppliers, particularly in North America. And then, we've had some smaller wins, and we'll continue to have smaller wins with existing civil customers, really offsetting some of those small declines in legacy programs as they come to a natural end of life. Next slide. So in terms of looking internally, in terms of the US, we've got, again, continued good progress. Very proud of the team out there and pleased with how they've adopted the Velocity way of working, and continue to hit the sort of KPIs where they need to be on delivery and quality. And that continues through as we onboard the remaining parts of those programs, and they begin to work on other new stuff. Finished and completed the capital expenditure activities over there, particularly around the new large freezer farm that's been installed. So again, that US site is fully enabled and operational to deliver on what it's sort of currently working on, and plenty of capacity there for future opportunities. We talked about the quality performance and delivery performance being key, particularly as we manage these industry-wide sort of fluctuations in demand as people prepare, start to ramp, rebalance, move things around. So again, a lot of time managing that with customers as we should, and working with customers to smooth that and feed that information in through the raw material supply chain accordingly to ensure everyone's fully enabled. And then the new business continues, and again, pleased to see that supported as well from teams in the US as well, as they get involved in activities, particularly on some of the more controlled data activities, which US nationals need to be supported by US nationals. And again, it's all part of the overall evolution of that team and that site to be a fully integral part of Velocity and its wider operations. In Europe, Rob mentioned the sort of margin improvements, and that's been twofold really. One is not so much price increases per se, although we've had to increase prices really to catch up some of the inflationary costs that have occurred through previous contracts. As we talked again in previous presentations, what we've done going forward is to make sort of those forward-looking contracts now annual price reviews to take into account any inflation, particularly around labour costs, sort of local labour costs, energy, and finance costs, which makes sense to us and our customers. The other part of the pricing material flows through anyway. So again, purely passing on inflation, not overall price increases to the wider contracts, but again, pretty significant inflation that we saw that we've managed to move forward into the new contracts. And then also, and just as, if not more, activity and reward from is continuing to drive our technology and implementation of Odoo to give us better visibility and sort of real-time data analysis around our internal operational efficiency. That's both in labour and our total operating costs, but also material improvements and material efficiency improvements to help drive and sustain that margin as well. So again, pleased to see that flow through and the team to not only develop those tools but also utilise them and to deliver a real improvement there in the gross margin. A350 ramp is important, we've talked about, and we see we're sort of saying there's no growth. Hopefully there will be, but again, that depends on when those programs ramp. We want to make sure that we're supporting our customers on those and preparing. But again, us and our customers don't want to get another sort of delayed ramp up. But again, I think what we're starting to see is real serious opportunities now for that program to ramp sort of later on this year as it needs to get to the levels that Airbus have already announced in order to sort of meet the deliveries that are required. And then new business in Europe really focused around more business with existing customers, different sites, different programs at existing sites, and that's both in the UK and obviously as we've evolved into mainland Europe to support from existing facilities. I'll hand you over to Rob, who will take you through some of the financial detail.
Thanks, John, and thank you for bearing with us, everybody. Revenue, as I mentioned on the opening slide, we are down a tad, but that's as customers rebalance their lines, mainly on the A350 program, where there was a surge to try to meet demand last year, and then the OEM cut deliveries. That's now gone through, and we're in a better place on revenue. Gross profit, the margins improved, as we've already said, operational efficiencies, and being able to pass some of the inflationary pressures which we've seen over the last couple of years onto our customers. Administrative costs are up slightly, but we're seeing a much more benign environment in the last 12 months than the preceding 12-24 months. And we've also been doing focused cost reduction activities to make us more efficient on administrative expenditure. All that has resulted in a reduced operating loss and the ability to post an adjusted EBITDA in the first half of the year. From a balance sheet perspective, bear with me. From a balance sheet perspective, the working capital is managed quite tightly. As you would imagine, we run quite a lean operation, and part of our pitch to our customers is we manage the material much more closely than they are able to, which means we have relatively light inventory. Trade receivables is always managed carefully, and we have all our customers performing to terms, which is very good to hear in any business. Our non-current assets increased in the period. Now, the main driver for that is we've swapped out some short-term temporary freezer storage in the US for a fully installed freezer farm, and that we've leased, but as it's a long-term lease under the recently introduced accounting standards, we have to capitalise that lease and recognise the cost on a monthly basis as depreciation, rather than charging the lease cost to the profit and loss account in a normal way. So a bit of an accounting issue there. We haven't spent 500,000 in leased equipment in fixed assets in the half. It's more like about 50,000. So we haven't had a big splurge all of a sudden, and it's just moved into a permanent solution on the freezers. That's all resulted in a modest cash reduction in the period down to 1.2 million. And if I go through to the next slide, you can see our progress on cash. So operating cash flows are positive, movements in working capital are positive. We had a tax receipt for R&D tax credits, which gave us an overall inflow from operating activities. The cash used in investing is principally the freezer farm, as I've mentioned before, and the cash used in financing activities is the interest on the long-term loans, which are principally the CBIL loans and the repayment of the CBIL loans. So it's using in the interest and repayment of those loans. You'll note that we're now down to 734,000 of CBIL loan, and that will fully be paid off in 2026, in the second half of 2026. So we're making good progress on covering the COVID loans, and we have a good cash position. On top of our cash in the bank, we have a facility which is up to £3 million on invoice discounting that we can utilise if we're required to do so. I'll hand you back now to John.
Thanks, Rob. So looking forward into H2, excuse me. I think we can work out how to open this up a little bit. Just bear with me 1 second. There we go. So yeah, looking forward into H2, we should expect to see something happen in key programs like A350 production rates. You've got the sort of recovery of 737 production rates as well as those issues cleared through Boeing, and an overall conclusion of this separation from Spirit, previous Spirit business as well. So again, the sort of conditions should be there for these rate improvements. And again, they're also good for not only existing business, but new business as well, as customers look to meet those rates by outsourcing and doing things differently. We're still working through the sort of final contracted program from our launch customer in the US. That's had some prioritization challenges with the customer and the OEM. We accept that, but we are working through that a little slower than we all expected, including the customer, but we're supporting them through the wider program prioritization challenges. The two key elements to that: the first sub-program is nearing completion, and then we start on the second sub-program and still look to get that concluded as soon as we can. But that obviously brings through the sort of final revenues then into that launch customer in the US, which we can move forward from as well. And in terms of the sort of new business opportunities, we mentioned previously we want to rebalance between civil and defence. Not that we're sort of stopping any civil opportunities. We're just focusing some of those larger bid opportunities around defence to get that long-term balance. And this continues again at different stages, but again, as we mentioned earlier, supported very pleasingly by the US team as they continue to grow and develop and really not only provide their day-to-day manufacturing asset that they are, but also the new business asset and the fact that they're US nationals allows them to work on some of the more controlled defence programs as we build that into our wider sort of portfolio of opportunities. We also still see good civil opportunities, particularly where those rates start to bite, as we mentioned, as it does put constraints on customers. And also, taking, what we've learned from, some of these prioritisation delays and, what that means to us and our customers, and, our focus on being that long-term supplier of choice for our customers. Frustrating as some of these program movements and ramp-ups are for us and our customers, we want to take that forward and continue to develop the offering as well. So we're currently completing some work on an enhancement to the onboarding process that not only brings clearer and quicker benefits to Velocity and our customers, but also mitigate the impact of some of those delays as well, to really sort of take those that evolution from what we've done so far and build that into the programs of the future. Still, there's clear board targets around gross margin, EBITDA, and return on capital. And again, I think you've seen good progress there with the underlying business. And we expect revenues in 25 to be comparable for the reasons we've mentioned. But again, that's all those is forecasting on contracted business. But we do expect to make progress on new business as well, not just the smaller programs, but some of the larger opportunities that we've been working on. So in terms of a summary, great progress on our internal efficiencies, great progress on working with customers to get some of those inflationary costs updated, and again building that know-how then into future contracts to allow it to sort of self-regulate a lot more, similar to what we do with the raw material costs. As we previously mentioned, some further prioritization delays with the sort of onboarding of those final programs in the US. Nothing too concerning, nothing around what we do or our programs, really around the prioritization of some of the wider activities within those programs. Again, we're a long-term supplier. We'll work with the customer to get those through when resources allow. As I say, we're pretty much there with the first of those two programs, and the second one will follow. And obviously, that will then form some very strong revenues going forward on those programs, and also brings us into a different area that we've not really served before, which is direct sort of aero engine sort of components. A350 should increase. We've seen the targets from Airbus that they're looking to get to. And as I say, we're ready. We see our suppliers being ready and our customers ready. And would like to think that those come through later this year, certainly into 2026, as expected. And we also, we talked pretty much at the year end, but also in our comms as well around strengthening our leadership team. We've seen the sort of performance improvements from the local teams at each site, and again to complete that, a recruitment of our long-term COO with a real focus on operational improvement, growth within sites, utilisation, and driving through a real continuous improvement ethos through all our manufacturing areas. New business hopper still being worked at various levels. Again, nothing there concerns me in terms of the size and progress in that hopper, or other than, as always, these are big long-term programs and take a while to work through. We see good progress. We see some new opportunities come through as well that we didn't have at the start of the half, and we'll continue to work those both in Europe and US. And continuing that sustainment in profitability and cash generation as we complete the programs that we're working on, get back to full profitability, deliver on our contracted business and obligations, and drive that through and those relationships through with customers into new programs.
Questions?
Yeah, back to Andy. Do you want to pick up on the next part?
Yeah, thanks, John and Rob. Everyone, just wait for anyone else who wants to put a question. well, and I will start. What I will do is go through the questions that we've had so far and chair them and put them to Rob or John, or if they want, I can answer any sort of particular questions. So the first question, which is broken down to a number of elements, but really is asking about the safety of using carbon fibre within a factory environment from fire and other, how it's kept and everything else. So maybe, and it's also its security and supply. So can you expect that there can be a greater demand in the aircraft parts, but can that be satisfied by the demand of supply of the fibre? So John, do you want to just cover off that area?
Yeah, thanks, Andy. So in terms of fire, it's not something we obviously have the usual fire safety activities. We take it very seriously. A lot of our buildings are very modern. Certainly, the infrastructure within them is very modern. Lots of the usual around detection and prevention. We don't see any particular flammability concerns with the raw materials. They're very handled in a very sensitive way. We store them in freezers, airtight, cold boxes with limited opportunities for fire to become a serious issue. But again, we never say never, and our usual sort of disaster planning activities will pick up those risks and mitigate them through predominantly prevention and detection. The raw material suppliers, I think, because we inherit the raw material suppliers, we don't get a lot of say or sway in who those raw material suppliers are. We have very good relationships with them, particularly around managing demand. But in terms of their own fire safety, I think that would be ultimately between the sort of OEMs who specify the raw material suppliers and the plants that each supply is made in. And I'm sure they've got their own plans around being able to switch production between plants should there be any challenges there. We've seen it historically around if there's any particular quality concerns with materials, they're able to move the production around different plants to satisfy that within the specifications. So I'm sure they're all large, well-established organisations. They've got their own plans in place, but we don't get any choice around that, and there aren't any second sources. What percentage? So yeah, as we said as well, we've previously been at much higher rates pre-COVID. So again, I'm sure these plants have the capacity to hit those rate increases. And because of the lead times of the raw materials, plenty of time for them to plan, obviously for us to plan, and the end users to plan to utilise those. So again, the time is baked into that, which is why we manage use that technology to manage such a lengthy supply chain.
Okay.
And in terms of location, sorry, Andy.
Yeah, I was going to ask you just how we, obviously there is a lot of opportunity within mainland Europe, but we're based in the UK, and maybe you could just explain how we would satisfy, say larger contracts that might come through in mainland Europe, particularly with current customers.
Yeah, I think what we've been working on over the last few years is more sort of hub and spoke type model where we have forward stock locations close to customers wherever they may be, even within country, because they need stock to hand. So we may look to have 1 or 2 weeks of finished goods stock very, very close to customers, maybe even on site. But that allows us to do our bulk manufacturing, wherever we can find the most optimal way to do that and utilise our existing capacity. So yeah, that's the way we're looking at some of the current and new opportunities as we expand.
Okay, so so what you're saying is it's quite easy for us to satisfy mainland European demand through our current main investments in the UK.
Yes.
The next question is just how are we using AI in our business? I guess the subtext to that is, can AI benefit our business?
Again, we're starting to look at it, with some industry partners around the demand management side of things. One of the things, because of it's probably on one of the appendix slides, actually, the VRP system, you can see we're having to manage customer demand, any demand changes through 6 months of material lead times, and keep those aligned along with day-to-day short-term manufacturing changes from customers as well. So I think that's where we could benefit from, and have started to look at taking the modules of our VRP system and utilize some machine learning there to preempt, predict, and build more self-regulating real-time dashboards to keep control of all those variables.
Great, thanks, John. Rob, do you want to remind investors of how much the management board have invested in Velocity?
Yes, thank you, Andy. It's about 12% of the current issued share capital is in the hands of the directors. The largest holder, obviously, is John as founder, but the other directors are building stakes in the business as we continue to develop. There is a program which we've got in place, which the non-executive directors, part of their remuneration is share-based, and that enables them to buy in further to the shares in the company.
Yeah, I mean, we offer to any the management the ability to swap some of their base salary with up to 20% with equity if they wanted to do that. So the next thing is really, we obviously in the presentation and in previous presentations have highlighted how Boeing and Airbus have these large backlogs and significant need to ramp up production. We give an example like A350, but we know there's multiple programs that need to have significantly higher production rates, and with the industry's even struggled to get back to the previous rates that we were achieving. The underlying question really, which investors have been asking here is, okay, that's great for the end market demand. How will that turn into growth for Velocity? Is it on those current programs? Are we on them already? Or is it new business? Or is it both? So John, do you want to articulate that area of strategy and sales development?
Yeah. Where we're obviously contracted with customers on programs like A350, then the rate increases would flow through. I think, as I mentioned earlier as well, we also see as those rate increases buy, and as we get past and back up to pre-pandemic production levels, we also saw that very helpful as well in terms of new business opportunities. Just as customers' plans get fuller, get more constrained, multiple programs, as Andy talked about, ramping back up at the same time, it obviously makes customers and potential customers look for ways of meeting that demand by outsourcing non-core business. And as we've talked many times previously around, our benefit is not just cost reduction, it's about getting rid of that inventory, getting rid of the floor space that doing this work internally at our customers takes up, and allowing them to really focus on building the parts and getting them built and moved on, and not to worry about the supply chain, which we manage with our technology and VRP system to drive efficiencies that way. So it's two-pronged really. We get a benefit from obviously our existing contracts, but also it helps the overall environment for outsourcing as well.
That's excellent, John. And we've had a question which is saying that given our operational performance has continued to improve, I'll answer this question. It's saying, would it reinstate the formal targets, and would we look at dividend policies in the future? And the answer is, we would consider those things. Obviously, we got the analysts who put out a forecast. And as most people know, that is done very closely with the company as well, and becomes what we call the market forecast. So there is forecasts out there from the analysts which tie into what work they've done with us, and that's gives, and the reason we got several analysts, it gives several points of view and opportunities for different people there to ask questions. When we only had one analyst, we did put out some forecasts ourselves, and when we've done some refinancing, we've done that to help the market. But at the moment, everything's aligned around that. There's no nothing really hidden or anything. In terms of a dividend policy, at the moment, it doesn't make sense because we need to reinvest any cash we have. Longer term, if we can get to the position we want to get to, where you saw the financial matrix that John had explained around 10% return on capital, 25% gross margin, 10% operating profit margin, then we should hopefully get into a position where a dividend policy can be established. But I think that's a fair few years away when you consider that we want to have some big contract wins, which we want to be able to finance ourselves. The next question is around customer concentration. John, do you want to explain that? Obviously, we're trying to build out our customer base. So it's a fair point to say there is some significant customer concentration, but maybe explain how, even though that does exist, at the actual behind that, there's then the programs themselves are far more spread. Programs.
Yeah, thanks, Andy. Well, as you know, we do discuss it regularly internally, and it's part of what we manage. But whilst I think it's just a fact of life that all our customers are large multinational organisations who have, whilst they might have one name and logo, they're very diverse sites in different countries, and then each of those sites serve different end customer programs as well. A lot of them split civil and defence, multiple platforms as well. So, if we look at that overall little spread, it's much more sort of palatable in terms of, approaching it from a purely concentration risk perspective. But I think we also do, have made a lot of progress in building those long-term strategic relationships with key customers as well. So we do have that senior level engagement, which means that as we win business, we then also look at other sites within that customer group, and also more work at the sites as well. So I think the opportunity and the challenge for us is to just manage that risk across the program level rather than be too concerned about the customer concentration level, the ultimate customer group level concentration level, because I think it's the programs that give us that diversity and security of any impacts to any one program not having too much of a detrimental effect of the sort of wider business.
Thanks, John. And the next question, as we all know, sadly, we've seen reported in the crash of Air India, the 787, which is Boeing's largest plane. And John, the question here is, if that investigation leads to some form of problem with the production, I guess, as we've seen with other aircraft, where there may be some delay or anything else on that plane's production in the future, which we have no, we don't know if that would happen or anything. But clearly we have seen it with other aircraft. They've just said, if that came to light then, would that potentially have an impact on our forecasts going forward, say for the next 18 months?
Yeah, like I said, Andy, we have no news beyond what's out in the public domain. Obviously a very sad situation in terms of the sort of human impact, and it's something that certainly anyone in the industry works very hard every day on to maintain quality and safety. But the sort of direct question there around ourselves, I think we have one program that supports an engine variant on 787. Material impact wise, just doing it's probably 1 or 2 million, something like that. I mean, it depends on the sort of obviously the outcome of the investigation, but I think from my own personal reflection, to see 2 engines fail at the same time is a very sort of statistically improbable occurrence, and we hope that they find the sort of cause quickly and the industry can move forward. But it's just, I think, one program where we're on in the US which supplies parts into 787. Right,
thanks, John. So what you're saying there, really, maximum 10% impact at the worst case scenario.
A lot, around those lines, yeah.
The next question is really, I think we've already answered. I've answered it, and Rob, you've answered this, but it's just saying that clearly we've done well now to get that gross margin up. It's actually above the 25%, but we do plan long term to run the business at least a 25% margin, don't we, Rob? But clearly, it's great to achieve above that at the moment. But clearly, at times we've been below that when we've been on a catch up in terms of price changes.
Yeah. And the mix of sales as they come through affects the overall gross margin. But we're certainly bidding all new business at greater than 25%. And my expectation is we will be between the 25 and 30% going forward.
Yeah, and I think just we've mentioned Ollie, our new COO, and there's no doubt that from the labour efficiency has significantly improved over the last 12 months. And that's what has been one of the great drivers to get us to the levels of margin which we thought that we should be able to achieve with these contracts. Would you agree, John?
Absolutely, yeah. Obviously all our contracts are based on a customer saving, and we drive them and stick to them, and the focus now is on our own internal operational, using the sort of knowledge that Ollie and the team have developed and continue to build on. And as the sites get busier, as rates recover and new programs start up, then we'd hope to see further operational efficiencies with scale.
Yeah. The next question is really another question just on the Air India. So I won't go into the details because I think John's answered that comprehensively. And, it is not for us to speculate in a formal presentation about what the issues are. And we hope that these can be identified as quickly as possible, but our thoughts are always with the families and everyone involved. It just shows why if you think about how we have had a few growing pains in the last 12 months, bringing on board some of those last programs. And those last programs are on key elements in the aero engine structures in terms of where the carbon fiber is used. And I think it just demonstrates that we've gone through a lot of regulatory checks and balances and having to work with our customers to get what is really just the first stage materials to be transferred to us. So hopefully that does demonstrate to investors that, the safety controls in the supply chain are very significant. And you can see how we have had to work through those. And they get even more significant as they come into the final assembly and production and maintenance as well. So that's, I feel, all we can say on the tragic accident that we have just seen. I'm looking and I can't see any other questions that have now come through. So I maybe just pass back to John to everyone and give a final sort of thoughts.
John, Rob,
Cool.
Andy, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Andy, can I please just ask you for a few closing comments?
All right, sorry. Well, I think that from a board perspective, we're very pleased about the operational improvements that we've seen in the last 12 months. Frustrated with some of the just getting the final programs in place. And as I've just explained now, then something happens in the industry and you realize why. There is that very, very tight regulation. And the way to turn this around in the thought process is it means that it does actually create a very big moat when you are then providing those services. And in the background, I know it can be frustrating, but we have a very lot of opportunities going on. It's just that there's a huge amount of engineering work that gets done up front to satisfy a point where you can sign a contract, and it's only on the signing of the contracts we feel that we should make a serious announcement rather than in the stages before that, as it is, that there is always a timing issue. I feel that we will go back into a serious levels of growth over the next 2 years on the back of both new contracts and the relationships that we've already developed now. And what I do see, and I'm really pleased about, is customers and their customers actually referring new business opportunities to us. And that was always part of our strategy when hitting the US in particular, to get known. And that's taken time to market ourselves, to get round the new opportunities and to say we are here, we have a factory, and we're ready to go. And there's no doubt, in my view, in the last 6 months in particular, we've seen very significant traction in that side of the opportunities. So I feel that it's a solid set of results in what was a very difficult market period, with a clear improvement operationally, and it builds the foundation for further growth going forward. So thank you, everyone. Appreciate those that have invested. I'm open to communication with anyone and site visits if required.
John, Rob, Andy, thank you for updating investors today. Can I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Velocity Composites PLC, we'd like to thank you for attending today's presentation, and good morning to you all.